homes. Victor, would you stand up? Or set guy here in this area, he's the man you want to talk to. Thanks very much. Thank you.
All right, how about that lunch? You like it? This hotel has done a great job on food. The food tonight, along with the cocktails, will be wonderful also as for lunch tomorrow. If you're thinking of leaving early, stay for the lunch. Also, the sessions are pretty valuable tomorrow also. All right, now we're going to get right back in it. Our session here at 2 o'clock is called Need Money to Buy New or Used Homes. Look no further. Most community owners now have realized the necessity and value of buying used homes, but mostly new homes perhaps, to fill up their empty lots. And a number of lenders have stepped up to help us finance those and not have to just use our own cash. So we have a large panel here because there are a lot of companies that want to help us, but everybody does have a little bit different geographical footprint, or perhaps a little bit different way of loaning you money. And so they're going to talk about their programs for 2 or 3 minutes each, and then of course we'll have the question and answer period as before. So I'll need a couple of purple shirts to help me with the microphones. For the first time, we're actually in order, sitting on the table. So Jeff Buice is the first gentleman here, and several people will change their names. Candace has changed her name to Ryan Howard. He's sitting number 3 here. And at the end, Kevin Thrash has changed his name to Andrew Bates, is it?
That's it.
Yes, Andrew Bates at the end. So we have switched a couple of participants, but they are with the same companies there. So if you're trying to keep the company straight, that's who we have. And we've got quite a collection of people from around different parts of the country. And let's just get started. We'll let Jeff take off to begin with, and we'll just go down the road.
Great, thanks, David. Thank you. My name is Jeff Buice from GENCapital here in Atlanta. We are sort of a boutique wealth management firm, but David warned me I tend to be a little long-winded, so I'll try to hurry it up here so I don't get any people yawning in the crowd. He said he'd yank me after about 2 minutes. But we're not your typical lender. We're not a bank. Basically, what we do is I primarily live, and my team does, in the sort of private wealth management world. Now, essentially what that means for you guys is we have negotiated a rate with our 2 custodians in that world, our TD Ameritrade institutional, which they have about $800 billion of assets they custody, and Charles Schwab as well. With TD, what we've been able to do is essentially negotiate a margin rate of anything north of $250,000 of borrowed money against eligible securities in a portfolio. You can get that at 1%. So it's almost unheard of. We have a lot of real estate sort of centric families and clients that we deal with that utilize these lines for their businesses and buy homes. And we deal with some residential developers, commercial developers. So it's really just a really good tool to have. Just as a quick case in point, if you had say $1 million in a tax-free bond municipal portfolio, maybe it's thrown off 4 to 4.5 tax-free is the current yield. Essentially, you can borrow up to 80% on that portfolio. Not that you would borrow that much, but you feasibly could. So just to put it in an example, if you're making 40 to 45 grand a year tax-free in munis, and you wanted to say you needed some capital, but you wanted to continue to let those assets work for you, you could borrow back, say, $500,000, borrow half of it, and your interest carry is only $5 grand a year. So you're basically you have that arbitrage there. So you're making 45 and you're paying 5 for the loan. So that's kind of the quick and dirty. We have a table in the back, so I'd love to, if anybody that piques anybody's interest, I'd be happy to go into more detail with you as well. And another guy from our firm, Andy Murphy, is back here as well. And Andy would be happy to chat with you as well. Thank you.
That was not long-winded. My name is Curt. I'm an owner and founder of Legacy Housing. And first, I just want to thank Spencer for putting on a great, great program. This is incredible. Last year, Legacy Housing bought the Horton facility in Edenton, about 800,000 square foot of buildings. And we started up building the same product we built in Texas, in Edenton, Georgia. So we've got a couple hundred employees. We're now up to about 3 a day. We expect to get about 6 or 7 a day. Part of our program in Texas, and we've been at it probably as long as anybody, financing mobile homes for mobile home parks. If you're from the Southeast, you probably would know that because we did pretty much Texas and a little bit of the Midwest. Our deal is really pretty simple. We finance at 8% interest on a 10-year note. Our down payment is anywhere from 5% to 25%, depending on the situation. No prepayment penalty. And a very simple note, and we don't take a note on a mobile home park, just a pure personal chattel loan. We do finance legacy, we finance used, we'll buy used, and we'll buy a portfolio of notes or finance a portfolio of notes if you have it. Or we'll use the portfolio of notes sometimes as collateral for less down payment. For those of you that attended this morning's session on leasing versus owning, I prepared 36 years in the business. I prepared a leasing versus selling matrix for you owners to consider when you're deciding whether you want to be sellers or lessors of the product that you acquire. It kind of advocates that you be lessors for a lot of different reasons. If anybody would like a copy of this after this meeting, I've got about 25 copies or so I brought with me, and I'll be happy to give them to you. We basically advocate that you be lessors. It makes you entirely legal. And if you aren't lessors, let's just say it's more difficult. We think Legacy builds the most functional, most durable product in the marketplace. We got one of them outside for you to look at. And I'll be available probably for 4 or 5 if anybody has any questions, and I'm going to go tell everybody what they're doing along with the plant and needs. Thank you. Thank you for coming.
Hi, my name is Ryan Norton. I'm with 21st Mortgage out of Knoxville, Tennessee. We're a national lender with about an $8 billion portfolio of manufactured homes, home loans to consumers. And we have a team that's focused primarily on communities, that we have some programs that we have put out there that are very robust and very good for bringing in new homes into your community to fill up sites and add that value to that with a lot of good options to exit those homes, whether it be a rental program or a consumer program. So we have a capital piece to the program we call Casper program, which stands for Community Affordable Spec Home. And that capital, what we do is we purchase those homes for you guys, and we give you a nice period of time, up to 1 year, for you to liquidate that home, either via selling the home to the customer or leasing the home or renting the home to the customer. So you have 12 months with no money out of pocket, and we also pay for the setup cost in your community, so you're able to fully fund that transaction, and it's all paid for through the sale of the home or a transaction of the home. So we also, as I mentioned, we also have consumer financing products for you. New and used financing products for your customers. The new homes, it's all of it's matched up that fits very well with the profile that you would normally see in a family community, and it gives you the ability to really move those homes, and whether it be new or used. We have a 80% approval ratio for our customers, and we typically book one out of every 2 applications for fundings on the customers. So it works very well. You can get a lot of velocity with the program and not have any money out of pocket. We also offer a couple extra things like marketing support for you, no cost. We provide banners and marketing materials to help you advertise a home, put out the lending product, help keep you compliant as a retailer when you're trying to sell the homes. And we consult you as far as, here's what we're seeing happening, here's success that we see that's going on in other communities, and we put together projects where maybe you own some used homes in the community that you're leasing that you'd like to sell to customers, and we do advertising campaigns to those customers. We also offer consumer lending support through the whole process. You get a dedicated MLO assigned to you at your community, and that way the customer can come in. Your property manager may not know everything about the financing process. This gives you an opportunity for that person to go work one-on-one with your customer and take them and navigate through the process of going through the is more complicated than it's ever been. So we've got Candace Doolan's here. She's back there in the back. We've got a table out there. If you'd like to hear more about the program or talk about it, we'd be glad to sit down and talk with you about what we can do and how it can help you.
Good afternoon, and again, thank you guys for having us. This is my second conference, relatively new to this space. I just really appreciate the welcome that we've gotten and the opportunity to be on one of these panels, so thank you very much. My name is Marc Katz. I'm from Chicago, and my firm is called Broadfield Finance. And I spent about 20 years as a banker, primarily with Bank of America. And about 5 or 6 years ago, I stepped away from that, and my ambition was to start a finance company. And the first thing we did was we started managing some portfolios of primarily tax-exempt bonds for family office type clients and other private investors. And then to sort of fulfill what we wanted to do, we started doing some private lending in real estate. And through one of those relationships is how we got involved in the manufactured community space. And maybe the best way to explain what we do is to tell you a little bit of how we got started in it, as with an example. So one of our real estate developer clients that we did some financing for, a multifamily project, he also owned 5 or 6 communities, and he called me up one night and said, we'd like to acquire another park. It's a great opportunity, but we have to move really fast. So one thing led to another, and we went and visited the park, and within 30 days we closed an acquisition financing for him. And then about 6 months later, he said, we have another opportunity, so we did another one for him. We did a senior and a mezz tranche. And then a little while later, he called and said, we'd really like to fill up the park with new homes. Would you consider financing that? So we thought about that and came up with a structure that made sense. So the first transaction we did to finance homes with this individual was we financed 20 homes. It happened to be from Clayton, but we're happy to work with any manufacturer. So we made the loan to an entity that the apartment owns, and we charged a pretty competitive rate, and probably pretty consistent with some of the other programs that are being talked about today. We gave a 10-year amortization, 5-year maturity. My thinking was after 5 years, everything's going fine, we'll just continue. So that was our sort of first entry into the space. And in talking with some of our investors, they really like what we're doing here. And we've grown it, and we'd like to grow it some more. We think it's a valuable source of financing, source of capital to support what you're trying to do. We certainly see the value in enhancing the community by adding homes. And then lastly, before I pass the mic, I'll say, with this, the first borrower that we worked with, he also asked us very recently to look at a portfolio of used homes that he's purchasing back from a lender to release to new tenants. So we're looking at that, and we'll probably close that this week. So a portfolio of used homes. So across the board, acquisition financing for the park, which is a different panel, so I'll stop there on that. And then more to the point, financing of the homes, both new and used. And like I said, it's a business we like and we love to grow. And please reach out to us. We'd be delighted to explore that with you.
Good afternoon, I'm Casper Koble with Country Place Mortgage out of Addison, Texas. Parent company is Capital Industries, so we're very entrenched in the manufactured housing industry. We came out with a program in May. It's a community rental program. And its target is for new homes. You replace some older homes or fill in a space. So if you buy a Fleetwood or a Cavco or Palm Harbor, or Fairmont home, or Cherry Eagle RV, we're there to try to assist you with the financing of the unit while you guys are renting it. Basically, the way the program works, our target is we're looking for a community that's going to buy 5 homes in a 12-month period. But I learned a long time ago there's no nevers and no evers, so that's not something you can do. Maybe your number is 3, we'll consider it. The The advance rate is 80% of invoice. Interest rate's 7.19%. And the way it works is for the first 12 months, it's essentially a line of credit. So we approve you for a line of credit. The first 12 months is called the drawdown period. Through that first 12 months, you pay interest-only payments. After that, it is converted to a permanent loan amortizing at the 7.19% for 10 years. At 5 years, there is a reset on the rate. It's based on the 5-year treasury and the spread between the 5-year treasury and what you lock in at when you sign the initial agreement. Each agreement is a separate agreement, so let's say you guys enter into a transaction with us today. You fill that line of credit, that's closed. If you want to do another deal, and we start another deal after that one. Let's see, what else? When you sell a unit, the way it works is we don't target what you can sell a home for. You can sell it for whatever you want to sell it for. The way the repayment works is, if, just for an example, if the unit you put on the line was 20% on the line, and we will look for 20% to be applied towards the balance. Whatever the balance is at the time of the sale of your line is what we will look for you to pay us on that unit. Short of that, there's not a lot else to say about the program. I have some brochures and stuff sitting out in the double-wide Fleetwood. It's called the Revive Program. Feel free to stop by. I'd like to meet you to answer any other questions you might have. Thanks.
Good afternoon, everybody. My name is Adam Peterson. I'm with GENCapital. We're based in Chicago. We are primarily an investor in manufactured housing chattel paper. We have about $450 million in manufactured housing loans located across the country. Our job when it comes to bringing new inventory into communities is to, number one, start off with maximizing utility of your balance sheet. If you've got leased homes, if you've got loan inventory or loan portfolios on your books, what I want to do is I want to finance those leased homes and buy those loan portfolios to give you cash to go out and buy new homes and put in your parks. And then when those homes are sold or those homes are leased, I'll finance that too. We have a program to, like I said, to buy portfolios of loans. We have a long-term financing program for leased homes that we can basically size to about 90 times your home-only rent. So if you've got a $400 a month home-only rent, I'm going to finance that thing for 15 to 20 years at $36,000. So that's reasonably competitive. I'll have a ceiling on that based upon liquidation value of the house. But in general, it's about 90 times your home rent. We have a new loan origination program where a correspondent lender will finance home sales, and then we'll buy those loans from them, so you don't have to finance them yourself. Because again, I want to maximize the utility of your balance sheet, and the best place for your money to be spent is putting new homes in and then getting cash back out of those once they get filled. And then secondarily, keeping the parks maintained. For those parks that have that are in the process of stabilization. If you've got some infrastructure you need to do, you need to bring in, the 30% of your sites are empty. You need to bring in a big slug of homes. We have a mezzanine product as well that'll help finance not only the new homes being brought in, but also infrastructure, site improvements, redoing paths, all that kind of stuff. We do that as well. We don't do a lot of it, but because it's reasonably expensive. But the way that we can help you most in bringing new inventory into your communities is by letting us finance what you already have. So you got the cash to go do it the way you want to. So I'm at table 15. I'm here today and tomorrow morning. I'm happy to talk about this further with you guys and answer whatever questions you might have as the presentation goes on. Which microphone do you want?
This one.
Okay.
Hello. I'm Andrew Bates with American Commerce Bank. We are, in one sense, your traditional community bank in that The president will show up and make jokes about my beard, and you can walk in and see him if you have a question. You can get me on the phone. The person that is getting your loan for you is who you're going to deal with, and you'll have access to them. We're not like a community bank in the sense that we love mobile home lending. We make loans to the community owners on the communities, and we also do it on the homes. We are not an end user supplier, so we're not going to make the loan to the consumer for you. That'll be some of these other guys. But if you want to put some homes in your community, we can help you with financing on that. We've got financing up to 15 years on new homes. We've got rates, a general range is 6.5% to 8%. We look at it on a case-by-case basis. But we do up to 80%. Generally, the easiest way to look at that is we'll do 100% of invoice from the manufacturer on a new home, and then you'll be responsible for transportation setup costs. So that'll be your equity into the project. We do have some interest-only periods that we can offer in certain cases if you want to put some homes in and have a short period of interest only where you get the home filled up. We proudly bank Spencer, and we're one of his biggest fans. We believe in his lease option program, and we're proponents of that. So we're at booth 5, and I'll be here today, and the different officers will be here tomorrow. We'd love to talk to you. Thank you.
All right. They've given me the job as moderator of the most difficult panel to understand. So let's take a deep breath. We had our lunch, and we're overwhelmed perhaps with some of these discussions here. But in summary, all of these companies are offering to establish a relationship with a community owner and establish either a line of credit or a loan facility that can rise and fall as your needs change regarding bringing new homes into your community. And so that's what they're all trying to do, but they all do have a little bit of different focus. Some people would prefer to lend mostly on new homes. Some people would prefer to lend mostly on homes from their own companies that they're affiliated with. Some people are willing to buy your existing loan portfolios from you so that you can get cash back and then go out and pay cash for the new homes that you want to buy. So it is a little bit complicated in that there's so many different choices, but what's great about our industry now, which was not available 5 years ago, is that 5 years ago when we wanted to buy new homes, used or new, we had to use our own money or go to friends that had IRA accounts, and you had to structure these kind of off weird deals. Now the industry has changed, and all these gentlemen here have numerous products ranging from 1%, if you have other type of collateral to use, up to ranges in the 5 to 10% area depending upon what you're doing. So that's my summary of what they said. On our questions, we're going to try something different to see if it speeds things up and is easier. If you have a question, we'd like to ask you to walk up here. There used to be a chair here with a microphone on it. Right. Okay. See, so, but if you have a question, if you don't mind making your way over here and kind of forming a little bit of a line, then we might be able to get through the questions a little bit faster. So if you've got some questions or think you might, please kind of ease your way over there. If you change your mind, you're welcome to, of course, go back to your seat. Now, as questions come, or hopefully some people work their way around there, I'll ask a question that wasn't addressed too much about geographical limitations. If you can do lending or whatever your program is anywhere in the country, then you don't need to answer it. But do any of you have any geographical limitations of who you can do business with? Okay, look at that. They're all willing to help all of you. Questions? All right, let me ask another one. In financing financing used homes, are there any limitations as to how old a home can be for you to consider some sort of loan against it if you already own it, or if you want to buy a used home in the repo market or from just some seller? What kind of limitations can you talk about?
Yeah, I would say that we really are, we start getting a little bit nervous on homes older than 25 years that haven't had any substantial rehab. If it's been rehab, the number one thing that we do is we're going to go out and look at every one of your homes. If we're buying a loan portfolio from you, we're going to come to your parks and we're going to look at the houses. If we're going to finance a rental home portfolio, we're going to ask you to work with us to inspect not only the exterior but also the interior of the house, so we know what that collateral is, and so we can come to a real determinate value of our underlying collateral. So I guess I could say we have an age restriction, but it's flexible depending upon the underlying condition of the home.
I guess what I would add to that, I think there's a lot of flexibility on that for us, particularly if the balance sheet of the borrower, the entity that actually is obligated to make the payments, or the personal guarantee of the community owner, that's very strong, and there's much more flexibility with regard to the specific asset that's being financed, because at the end of the day, with a lot of these transactions, it's really about your strength as a borrower as opposed to any specific asset.
That's a good point in that, you have a question? Okay, hold on. That's a good point, and it reemphasizes that as opposed to getting a loan for a community, if you're buying a car, that's more considered a one-time transaction. You get a loan, maybe you don't deal with that bank anymore, except as long as you're paying and you're happy. In all these instances here, these companies are interested in establishing a relationship with you, and the relationship depends upon your knowledge of the business. It depends upon the strength of your financial balance sheet. It depends upon how well you can renovate old homes and keep them in good condition. So you are establishing this relationship with these people. It takes a little bit to get going, but also it makes the rates a little bit flexible, because you may not be quite as strong as the next person. So where they might offer 6% for one person, they might offer the next person 8%. That's not all bad if your experience warrants that and allows you to fill up your communities. But their numbers aren't quite as competitive, just down the line as you would get from a normal lending on a park purchase. Am I misspeaking? I'm not misspeaking, am I? Okay. And I think we had a question here. I'll just give you my microphone.
As I mentioned during the introduction, we're a nonprofit owner, and we finance our parks through tax-exempt bonds. So we have a lot of reserves, our balance sheet is very strong. We have mostly 100% filled in our parks. A couple that we need to turn around, and we're having trouble with the residents getting loans on for less than $25,000. So I wondered if you could speak to those really maybe $10,000 to $20,000 loans. We're evaluating how we would fund those or how we would promote those. If we would be the mortgage, we're not a mortgage originator yet, whether we lease option, that kind of thing. But my question mostly is, do you fund a portfolio of mortgages that are less than $25,000? And what is the LTV?
Absolutely, number one, absolutely, we'll fund our threshold on new originations is $10,000. But if there are loans in portfolios that are in that $10,000 to $20,000 range, we'll do that all day long. Our threshold from a loan to value standpoint is, as I said before, we'll go out and inspect the house. We'll perform our own collateral evaluation, and that's normally going to be driven initially by a NAT evaluation informed by our inspection of the house. And so that's going to end up being, we're going to limit it to about 90% of that NAT retail value.
Now, Jeff, your program obviously wouldn't work for a nonprofit because they don't own extra securities that they could use as collateral. But would the rest of you potentially do business with nonprofits as counterparties?
Legacy's position on paper on youth houses is we have a staff of about a dozen bilingual collectors and field reps. We look for what the payment is. We don't value paper with a payment less than $300 per month. So it could be $3,000 if the payment was still $300 a month or so. We don't mind servicing that type of paper, which we do routinely. And but probably if you're trying to sell the paper, there may be deeper issues than what size loan is, because it does sound like you're a loan originator, and so that's something you can do. Yeah.
Okay. David, you have a...
Just because we're nonprofit doesn't mean we don't have cash in the bank. We can secure those, we can guarantee them, we can do all kinds of things. We just have to keep our money in our park and out of our own personal pocket. So as long as we're spending that in the park, securing something in the park, it's value of our money.
We have as I mentioned earlier, I almost mentioned it as a throwaway, but actually may have some relativity to what you're saying. We have a couple of tax-exempt bond funds,
Yeah.
and I can envision where that could be an appealing asset for those funds.
Yeah.
But one thing I just want to be sure is that we're not really set up to do consumer lending. It would have to be a sort of business-to-business type of facility. I'd be happy to talk to you about it afterwards.
David?
I want to add one other thing. We do have a couple relationships with some community operators where they're utilizing their own cash, and we originate the business. We originate an end service for them. We work together with the operator to come up with the underwriting criteria, and then we implement it. We're the lender and the servicer, and you guys just contribute to that.
And you go $20,000 and that's all day long?
It depends on what the customer wants.
Did you say some of these were person-to-person transactions where you're not really acting as a retailer?
Good question. A lot of the homes we get through like lead sale. Yeah. So, we are a dealer, so we could be, we do that through there, but the homes that we're talking about are homes that we're getting through lead sale.
Okay. Well, we have a whole division that's dedicated to that they can work with that. It goes down as low as $10,000 minimum loan amount.
Thank you, Ryan.
I'm questioning how you're going to determine the value of that used home portfolio. And before you answer that, I just want to kind of make a comment here. In 2012, we sold a 98 model house for $14,000 on a, we actually carried the paper on that one. We repossessed it here just a couple of months ago and went in and rehabbed it. And now we just redone it on a lease option for $25,000 value. And we can tell you that all of the homes that we've taken back that we sold 3 or 4 years ago have a much higher valuation than what they did then. So I'm kind of questioning how you're going to set up your, how you're going to evaluate those houses. Is it an NADA or?
Well, as I stated before, we set a foundation using the NADA. But then we are, like I said, also, we're going to come out and inspect the house, and we're going to look at local comp sales to be sure that we get a real sense for in that submarket how that house is going to perform when or if it comes back to me. So again, my foundation is based off the NADA, and then I'm going to go up from there based upon quality inspections and local submarket information.
All right, one more question. I think we're about out of time.
I have one.
Hello.
And my question is, we haven't been in this very long, maybe 5, 6, 7 years, but what fundamentally changed where we had to do our own financing only 5 years ago? I mean, we were in the same boat. Interest rates aren't that much different. The market's not really changed all that much. I'm just wondering from the bank's point of view, what's changed?
So why have you all gotten into this business more aggressively in the last few years?
That's correct.
Is that the question?
I think the biggest, well, there's several reasons. I'll just give one and let the other gentleman comment on other reasons, but one of the biggest drivers, not only in this space for non-bank lenders, private debt capital emerging, has been the tremendous regulatory environment that's stressing the banks. It's very difficult for the banks under a whole variety of regulations for them to do anything of the scope and range that they used to do. And furthermore, even if they could, the amount of time it takes for them to meet all these requirements in order to do a loan is very different now than it was 5 or 6 years ago. So the regulatory environment, and really to a certain degree the sclerosis, particularly with regard to the very largest banks, has really provided an opening for firms like mine and certainly the other gentlemen's to provide capital into a market where it was really owned by large financial institutions that had a lot more flexibility. But there are other reasons that I'm sure other guys can come up with.
Anybody else want to comment on that? That was a good answer, Bill.
Well, we've been doing it for a long time. And legacy programs have been around a long time. So that some of it's just that it's unknown. I mean, this space is. You look around. I remember the first CECO meeting. You know, this building is full of a lot more people than it used to be. It's a more popular space, and you start to see it. I mean, we realize that this is a good space to operate in under the right structure and the right program. There's a deal to be had here for each one of us, and I think people will catch on to that over time. So. It was something, you look back 5 years ago, we were not very far away from the Great Recession and the challenges that you had there. So I think that was a little bit of a difference maker.
All right, we want you to vote with your text and give us some opinions and all on that. Can we put up the slide one more time of the participants here? And let's give them a round of applause. We're going to go right into the next session, just in a minute or two, so it's not an official break time. If you need to go out and get some water, come back in, you can, but we're going to start